Retirement math used to be easy, right? You'd save, invest, earn about 4% a year, and live off the dividends. Simple. Done. But not anymore. Today, things are different. The market's unpredictable, interest rates are swinging, and safe 4% yields, they're not cutting it for most people anymore. So what if I told you there's an ETF offering over 120% yield right now? Yeah, sounds like clickbait, right? But it's real. It's called MSTY. But hang on, before you smash that buy button, there's a catch. There's always a catch. In this video, we're going to pull back the curtain. I'll show you what MSTY actually is, how it can pay out those insane yields, what risks you're really signing up for, and why a $10,000 investment might sound like it'll make you rich, but could also quietly erode away in the background. Stick with me, because by the end, you'll know whether MSTY is a passive income machine or just a fancy way to spend your own money faster. What is MSTY, and why it's not your usual dividend ETF? All right, let's start simple. MSTY stands for Yield Max MSTR Option Income Strategy ETF. Now, I know that's a mouthful, but here's the quick version. This fund is designed to give you high monthly income by targeting one stock, MicroStrategy, ticker symbol MSTR. But here's the twist. MSTY doesn't actually own MSTR shares. Nope. Instead, it uses options to simulate owning MSTR. Why? Because it's cheaper, faster, and way more flexible, but also way riskier. Unlike traditional ETFs like SCHD or VYM, where you get dividends from companies making profits, MSTY pays you from, well, option premiums. It's like the fund is selling insurance on the stock's price movements, and those insurance payments, that's your so-called income. How MSTY pulls off these massive payouts. Okay, now let's get into the engine room. MSTY pulls off these big monthly payouts with a two-step strategy. Step 1. It builds a synthetic long position in MicroStrategy stock. Basically, it buys call options and sells put options to mirror MSTR's price without buying the stock directly. Think of it as a low-cost way to pretend you own MSTR. Step 2. It then sells covered call options on top of that position. So it collects premiums from investors who are betting MSTR will go higher, and MSTY takes those premiums as income. Sounds clever, right? But there's a catch. If MSTR skyrockets, MSTY can't ride the full wave. The gains are capped because of those sold calls. And if MSTR crashes, MSTY eats the losses like it actually owns the stock. So you're limited on the upside, but fully exposed on the downside. Now, when the market is calm and MSTR is moving sideways, that's where MSTY shines. The premiums roll in and the payouts look great. But when volatility drops or when MSTR makes a big move in either direction, the machine starts to stutter. The hidden risk, where MSTY's yield really comes from. This is the part they don't put in the flashy ads. You see those huge yields, 120% plus, $4.40 per share per month, but here's the truth. Most of that is not income. It's return of capital, meaning they're just giving you your own money back in pieces. Imagine taking $10,000, slicing off $400 every month, and calling that income. Feels good in the short term, right? But after a while, you're left with, well, not much. MSTY's NAV, that's the actual value of the fund, has already dropped 27% in just 6 months. That's massive. And it's not because the strategy failed overnight. It's because the fund is structured to sell itself off to maintain that high yield. This is called yield erosion. The fund looks like it's printing money, but really it's liquidating itself slowly to send you those juicy payouts. The long-term math. What happens to a $10,000 investment? Okay, so let's get to what everyone really wants to know. If you invest $10,000 into MSTY today, what happens? Now, MSTY headlines shout 120% yield, but we need to get real here. Based on performance and what we know about options-based ETFs, a more realistic long-term yield might be closer to 15% annually, assuming reinvestment of dividends and favorable market conditions. So what does that look like over time? Year 1, your $10,000 grows to about $11,500. Year 10, you're looking at around $40,000. Year 20, that's about $160,000. And year 30, you'd hit approximately $660,000 in total value. And here's the monthly income part that excites people. By year 30, you could be pulling in over $7,000 a month in dividends. Sounds amazing, right? But don't forget, this is assuming everything goes right. Volatility remains steady, option premiums stay attractive, and you consistently reinvest those payouts. It's possible, but far from guaranteed. So, who should even consider MSTY? MSTY isn't for your grandma's retirement portfolio. Let's just put it that way. This fund is more like a high-maintenance sports car. Looks exciting, but it needs constant attention. It's built for investors who want aggressive monthly income and understand the risks of NAV erosion and volatility dependence. Here are the main risks you need to know. 1. NAV erosion. You're getting your own money back as income. 2. Limited upside. Gains are capped due to the covered call strategy. 3. Full downside exposure. If MSTR tanks, MSTY feels every bit of it. 4. Liquidity risk. It's a niche ETF, not a high-volume index fund. 5. Strategy fatigue. If volatility dries up, so do the payouts. In plain English, if MSTR, which is heavily tied to Bitcoin, goes quiet or tanks, MSTY's income could vanish fast. And since you're not building long-term growth with ETFs that actually grow over time, not just pay you your own money back, there's no foundation to fall back on. So here's where I stand. Would I bet my retirement on MSTY? Definitely not. It's not built for that. But as a tactical short-term income play? Maybe. If you're active, disciplined, and understand it's a cash flow tool, not a wealth builder, it can be useful. But if you're thinking MSTY will compound like SCHD or build generational wealth, nope, it's not that kind of party. It's a yield amplifier. Powerful if used wisely, dangerous if misunderstood.
So now that you've seen the real story behind MSTY, what do you think? Would you trade long-term growth for a high short-term income, or do you prefer ETFs that quietly build wealth over decades? Because here's the truth, not all yield is created equal. Some ETFs grow your money, others just return it to you in slices. The key is knowing the difference before you commit.